How pump and dump works in the cryptocurrency market. Pump and dump is a manipulation strategy in the cryptocurrency market, and also in other financial markets, in which investors attempt to artificially inflate the price of an asset to profit from selling it at a much higher price. Here's a detailed explanation on how it works. Pump. The first stage involves the pump injection of money into the target asset. This can be done through online forums, social media groups, messaging apps, and even email. Manipulators attempt to convince other investors that the asset in question is an incredible investment opportunity, often spreading false or exaggerated information about its growth potential. Price increase. With more investors buying the asset, demand increases and, consequently, the price rises. This increase can be rapid and significant, especially if the asset is low liquidity and susceptible to manipulation. Attracting investors. As the price rises, more investors are attracted to the asset, many of whom are influenced by fear of missing out, or the hope of quick profits. Dump. Once the price has been artificially inflated to a level satisfactory to manipulators, they sell their holdings of the asset at high prices. This stage is known as dump. As a result of mass selling, the asset's price will quickly plummet. Loss of innocent investors. Investors who bought the asset during the pump phase suffer the most, as the price collapses as soon as the manipulators start selling. They are often stuck with an asset that is now worth much less than what they paid for it. Legal consequences. Pump and dump is an illegal practice in many jurisdictions as it constitutes market manipulation and fraud. Financial regulators, such as the Securities and Exchange Commission, SEC, in the United States, are on the lookout for this type of activity and can take legal action against perpetrators. Anonymity. Despite the traceability of transactions, many cryptocurrencies offer some level of anonymity to their users. For example, in Bitcoin, wallet addresses are not directly linked to users' identities. This means that while transactions are traceable, it is difficult or impossible to trace them to an individual. There are other cryptocurrencies designed specifically to provide stronger anonymity, such as Monero, Zcash, and Dash. These currencies often implement advanced techniques such as confidential transactions, currency mixing, and zero-knowledge proofs to hide information about senders, recipients, and transaction amounts. It is important for investors to be aware of this type of manipulation and exercise caution when making investment decisions, especially in volatile markets such as cryptocurrencies. Careful research, fundamental analysis, and prudence are essential to avoid falling for pump and dump schemes and protect investments. Thank you, guys.